very brief introduction to equity research and valuation, why it is one science that we should master as a skill, because it not involves a career choice, but it also actually involves an opportunity for you to augment your personal wealth, right? So what is equity research and valuation all about? Equity research, as most of you might be knowing, is to do with studying the factors that will determine what is the future of the corporate performance and hence impact the share price movement, right? So if you are able, yeah.
Can I start with a formal introduction? Then you can go ahead.
I'm sorry.
Yes, sir. Yeah. So it's okay, sir. No, not a problem. Yeah. Yes, sir. So a very good afternoon, everyone. On behalf of Institute of Management, Nirma University, I, Nisha, welcome you to today's webinar on equity research and valuation. Our esteemed speaker for the session is Mr. Vineet Wolinchka, Head of Research at Ventura Securities. Sir has been associated with the Ventura Securities since 2009 with a rich experience of 28 years in investing. He also runs his online training academy known as the School of Market Studies. Prior to working in Ventura Securities, he has been associated as a proprietary trader in Sripati Holdings and Finance Limited and sales trader at Dresdner Bank of Zau. We welcome you, sir. Without much ado, I would like to ask Mr. Wolinchka for sharing his valuable insights with us.
So thank you for that nice little introduction. As I was saying earlier, is that equity research is one topic that every individual should master, because not only is it working to you from a career point of view, but also it's very important from building your personal and financial wealth, right? So it is a topic which is should be taught even at the school level, at least at an introductory level, but we will learn it out here. So what is equity research all about? Equity research is nothing but understanding the factors that influence a business, okay? And we study all the factors, we make kind of forecasts around that, right? We build a financial model, and then based on the financial model, we apply some valuation tools to understand whether the current price which is quoted in the market is lower or higher than the derived theoretical value. Okay, so the financial model that you build in Excel, if you feel that, let us say a stock is trading at 150 rupees on the stock market and its financial value as per you going out, say maybe 2 to 3 years down the line would be about 300, then you would be looking at doubling your money in a period of about 2 to 3 years, right? And hence, what will you say? That the stock is undervalued and deserves an investment. On the other hand, if you come to a conclusion that the price should be only 100 where it is quoting at 150, then it is a fit case for selling out because it is expected to be overvalued. So this is how this is the basic broad facets of what equity research and valuation is all about in this very, very simplistic terms. Okay, but when we think about equity research, it's a very, very exciting field because we are doing a lot of in-depth studies. See, we are studying all the factors and trying to understand what the causes which will affect the business, right? So we go into the depth of it, right from understanding the promoter, who's the promoter behind the company. So just imagine that somebody in your family who is looking for a spouse in an arranged marriage kind of scenario. What do we notice during those times is that we do a lot of study about the family of the person, the characteristics of the person, the abilities of the person, their financial well-being, and the health of the person. So all these aspects are considered, right? So in the same way, what we do undertake when we look at promoters is we look at their passion for the business. We see whether they're 100% committed to the business or not. Okay, we try to evaluate and see whether they have other interests which may distract their attention from this. Okay, then when we talk about promoters, we not only mean promoters, but we also mean the professional team along with the management, right? So we try to assess who are the key players in the management, whether there are some pinch hitters like Kohli, or whether there are some big players like Mahi or someone like that. So what we want to assess is how good is the team that is going to take the business forward. Because you have to understand one thing, that at the end of the day, it is the people who drive the business, right? And it is, if you have a good understanding of the, you are in for a very, very uh, of the business invest. About the promoters, then what we see is what is the business of the company into. So so let us say they are into the telecom business. So when you say they're in the telecom business, then we would venture into that market to understand the dynamics of that market. So when we say dynamics of the market, what do we mean? Who are the players? What is the technology? Uh, what is the pricing scenario? What is the growth in the factor? What is the penetration? What are the market shares? And after doing all the assessments, we try to get into an industry which has got sufficient growth factor, has got long-term promising potential, and you try to see how you are a fit in that business with the other competition. So you then see how the company's strategy and what moats does it have. So when you talk of moats, we mean competitive advantage that the company has, which will drive all these factors forward. So this is all that analysis that we do. Okay, and once we are satisfied that the promoter is good, the sector has a decent outlook, it has got a lot of growth factors and tailwinds, and the company is also not a ordinary player. They're also got their competitive advantage, or they have an edge, and they're well set to take on that space and grow faster than that space. So let us say sector is growing 8% and you grow at 15%. So not only are you growing faster, but you're taking a lot of market share out there also, right? So if you're looking for these kind of initiatives that are there, once we are satisfied on a on a tangential basis what is happening, we then try to put the concept of what we have spoken about into numbers. So we are translating the language and action and effort into uh, financial accounting language, right? The language of accounts. So what we do first, uh, we take a lot of data which is historical. So while we have spoken and seen what the company is all about, okay, now we want to assess how well it has done previously. Because ultimately, only if you have got good credentials in your academics will you get a good job, right? So in the same way, we assess the academic capabilities of the company in terms of dealing with highs and lows in the industry, how their previous growth has been across cycles. All cycles are not the same. So you might have, if you see a 10-year analysis of the past, you might see there were three cycles, two up, one down, and you believe that in the down cycle they did better than their competitors. Okay, but in the up cycle they could not seize the advantage. Okay, and then you feel that they have corrected measures. Okay, so you are seeing that the company is now well positioned to take advantage of the new upcycle that is coming in, right? So we understand all those facets in terms of their growth rates, their margins, their costing, how much debt they have on their books, what are the goodwill or the patents or the technological abilities there, what is capability, what is the capacities that they have, can they take on the entire growth that is available to them, what period of time can they take it up, okay, how well are they funded, do they need more money. So when they need money, do they need to raise equity? If they need to raise equity, can the promoters bring in equity, or they need to go to the market for that? So we understand all these factors. We understand the balance sheet. We understand the uh, profit and loss account. We look at the cash flows, because just making net profit is not enough. You have to actually make the cash, and then we lay a lot of importance on the cash flow. We understand what the cash flows are. Okay, and once we have done these three kind of scenario analysis of the three books of accounts, okay, we go a little further and project what the company would be doing based on what is our assessment of their future capability. So if the company is growing at 10%, can they increase growth rate? So if the increasing growth rate, is the market conducive to growth? Do they have the capacity? Do they have the wherewithal? Do they have the manpower? Do they have the technology? Okay, so we assess that areas, and then we come to a conclusion that, okay, this company is going to grow well, and you put your numbers in place, forecasts. Okay, once the forecast is done, you build out a forecasted financial model, or P&L, balance sheet, and cash flow. You do your ratio analysis, and then you compare this estimated balance sheet and cash flow and P&L of yours with those of the other players in the market, and you come to a conclusion on the valuation, whether the stock is a better investment bet, is going to give you better returns at lower risk and with high quality. Okay, so we assume all these factors, understand all these factors, and then come out with a buy recommendation or a sell recommendation, right? So this is the entire process of equity research and valuation that we do. Okay, actually I can speak for hours on this, but for your to give you a brief idea of everything I've told you in just the micro factors entail. Okay, so having done this, it is a never ending process, and it is very exciting because the world is very dynamic, and you look at very different categories of businesses. Sometimes you're looking at pharma, sometimes you're looking at steel, the other time you're looking at tech. So as a person, when you're doing equity research and valuation, growth is unlimited. Okay, the learning and the growth for you is fantastic, and it's absolutely phenomenal. You will become an expert on so many industries if you are connected to that, right? So not only are you going to become a better person in terms of understanding of business wherewithals, but also be a master of forecasting and projections. And once you do equity research and valuation and you study it really, really well, okay, what is going to happen is that this will be the fundamental building block for any finance position. So let us say you want to get into investment banking, you want to raise money for someone, you have to build financial models. Okay, if you have to build financial model, you have to do equity research and valuation. Okay, if you're on the corporate banking side, you want to raise money for corporates, right? Or you want to raise equity for corporates, you have to submit a proposal to the bankers or to the institutional investors. Okay, let us say you become a strategist. Okay, even as a strategist, you have to undertake all these plethora of estimates, do the SWOT analysis, figure out a competitive advantage, figure out where you lack, what are the things that you're good at, focus on the markets, focus on your strengths, minimize your risk, or lower your weaknesses. So you're all the time doing that, and for that you have to do equity research and valuation, right? And on the basis of that, the promoter will decide how much money to deploy, how much return he'll make, what kind of return will he get. The promoter will decide whether I should be putting money in this business or I should be putting it outside, right? And then there will be some private investors who come, there will be institutional investors who come, there would be venture capital funds who come, and they would be all doing all this kind of analysis. And then you would be looking to list your company abroad. For this also you need to do equity research. Okay, now think of another fact, that you are raising debt. Your debt needs to be rated. So the promoter comes to a rating company. Even at the rating company, you have to do equity research and valuation. Okay, let us say you're investing in fixed income, you have to do fixed income valuation. For that you need to study a company, you need to do equity research, right? So even if you go to a bank and you're a corporate banker and a corporate financer, you need to do your equity research, right? So as you can see that in the field of finance, if you master equity research and valuation, you are tops. Number one, you are an all-rounded personality with an understanding of every aspect of the business. So whether it be evaluating the business, whether it is me evaluating the promoter, or whether it is understanding the financial mechanics, or if it is focusing on financial modeling, or it is doing valuation, comparative valuation, intrinsic value. There are various models that we follow, right? So this entire process of equity research gives you a very, very strong standing in any field you can think of. Even tomorrow, if you decide to become an entrepreneur, you have to first assess your own potential. Then, what are your capabilities? What are your abilities? Which is the market you're going to get into? You have to stratify that market. You need to focus, you need to strategize in that market. You need to evaluate a competitive advantage. You need to build competitive advantages. I need to project numbers and build a business model to make a business, right? So whether you are a promoter, a venture capital, private equity, asset management company, banker, creditor, a credit rating agency, insurance company, everywhere you need to do equity research to, you know, understand the business that you're working on or you are working in. So, having understood the important necessities, I would say that it is a fundamental building block and it is not taught at the university level in the way that it should be. It's a, it's a, how should I put it? It's a, paradox of modern education. But anyways, I have explained to you all these things, and this was my limited point. And I wanted to talk to you about some companies, how they can build your wealth. I wanted to share one example from my personal, exposure when I picked up my first stock, which became a 100 bagger. So it gave me 100 times money, and I will give you a faint idea of what kind of effort it entails. So I was very young, about 27, 28. Okay, I used to earn a salary. Salary was just enough to take care of my expenses. My savings were very less. And one day I chanced upon this company called Mastec Limited, which was, expanding. And to understand the company, I went to the campus. But at the campus, the CFO had given me a time, but he had mixed up the dates. Okay, so I was supposed to meet him on Wednesday. He called me on Tuesday, and things got funny. So, anyways, what happened is while I was there, and I had bunked my office and gone there. So, although I was doing office work, I was doing it for my personal self, and I had taken my own initiative and gone without telling the company. So, while I was there, I was very dejected because I couldn't meet the CF. But I met his executive assistant, and he told me that we have X amount of business from US and Y amount of business from Europe or UK. So I said that, I already have that information. I was not very happy with what I was told. And, so I went and sat in their canteen. I was having a sandwich, and when walked in one of my friends who was with me in, engineering campus. So he took me around, and what I could notice is that, the entire place was flooded with people. The cabins everywhere were, there was no place to sit. And it was so busy. It was obvious to me that, some great things are happening in this company. So that night, that evening, afternoon, when I came home, I took and there was very little coverage on this Mastec story. So I took some reports. There was a sell report on the stock. The management was very poorly rated. But I took that sell report, I picked up whatever data I could, and I projected a model for 2 years. Okay. And I didn't do an entire balance sheet and cash flow thing. I did only a P&L with it. And believe you me, I was very confident on that stock. And what happened was that stock was, somewhere around 200, 250 rupees. Okay. Whatever little stock that I could buy, I went and bought. But my job was of a sales trader, right? So I went to all my institutional clients, both in Asia Packs and in India. And I told them that, you should buy this stock. Okay, it's going to go bonkers. And everyone was like, are you sure? Management is not well rated. do you think it will happen? And there are so many sell reports. I said, what little work I've done is great. And you will not believe this. In a matter of a year, that stock from 220, 230 levels went to 8,000. Okay. And what little investment I had multiplied so many times that, I could enjoy all the comforts that any teenager would want to experience in his life. So, this is the beauty of equity research. When you are convinced about your idea, when you put in your effort and build your models, and the stock price rewards you, then your financial wealth knows no bound, and you will always have the fire that is uh, you know financially independent and retired early. So all of us work for, what do we work for, right? We are working to improve our financial condition and live the life we want, right? So equity research is a single more important field which can level the playing field between the rich and the wannabes. And if you're a wannabe with equity research understanding and equity research in your blood, the rich man status is yours for the asking. So with that, I will end my limited discourse, and I want to interact with you guys more, okay? So that we can, you can have good takeaways at the end of the short 1 hour presentation.
Thank you so much, sir, for your valuable insights. I'm sure the participants must have gained more understanding on the topic. Now I open the floor for questions. You may unmute yourself and ask the questions or type them in the chat box.
Hello.
Yeah.
Good afternoon, sir.
Yeah.
Sir, I'm Hitan Kushal Singh.
Okay.
Sir, I have a question regarding this. That sir, there must be some kind of considerations while doing an equity research, right? Or analyzing the risk in future. So,
Yeah.
but as this current situation is quite unprecedented, and all those research analysts might not have predicted that this kind of situations might come in future. So
Yeah.
what are the changes? What are the changes that this analysts are taking after this COVID in consideration?
So I will answer your question in two parts. Is that it is not the first time that humanity is facing a epidemic,
Nice. Yes, sir.
right?
Yes,
And
sir.
stock markets have been present when epidemics have been hit us. So if you go back exactly 100 years, we had the plague. Okay. And if you see that the market has evolved over a period of time, and if you notice the exact same steps were taken that time. So you had people being quarantined, right?
Yes, sir.
So quarantining was the only way. And when you quarantine, you lock down, and when you lock down, your economy comes to a standstill, right? So we have seen all this happening in the past. Okay. The unfortunate thing is data is not available. And if you had the data, you could have very well said from that these things happen, and once the vaccine is delivered, then the growth story re-emanates, right?
Yes,
So,
sir.
so it is not the end of the world. It is a very, very bad pause, okay? But it is also a great opportunity, right?
Definitely.
And secondly is, if you see the valuation multiples, so we had a pandemic and we had a financial crisis which was separated by a 12-year period, right? 2008, 2020.
Yes, sir.
Now, in both the effect was the same, right? The causes were different, but the effect was the same. What was the effect? Stock prices fell down. The stock market melted. But after the financial meltdown, what happened? There was a
It again.
lot of pump priming of equity, right? There
Yes,
was
sir.
a lot of economic stimulus. You had printing going to infinity. And what did have what we had the biggest bull market of all time, 12 years bull market, right? And now, when the same situation has happened, they are doing the same effect. So, how do you think things will be different, right? Only thing is that, so we had this fierce rally happen, and we had the experience of a pandemic, sorry, of a market meltdown. So, we knew exactly what would happen in the market. So, if you study the historicals, that is why I told you that, we studied 10 years of history to understand how well the company dealt with it. If it was a down cycle, how did you perform? Okay, what were your learnings in the two upcycles? Was your first upcycle better or second? So if your first upcycle was good, but your second upcycle was not that good, why was it not? So always we are analyzing market cycles and seeing how well you did and why you did not do, right? So as a you are a crime detective novel. So sorry, crime novel detective. You have to ask these 6 questions: what, when, how, when, where, and why. Okay, 7 questions rather. So you keep doing the inquiry, satisfy yourself to get your answer. Okay, if you don't get the answer, you keep diving further. So I'll give you an example. Is that we had done one report on Godrej Consumer. Okay, just before this, I had a call with the management for 1 hour, and the company had not done well for 3 years, and after that, suddenly they are going to grow 20%. Now, a company which was doing well till 2017, suddenly it grows only at 1% CAGR, and now they are saying we'll grow at 20% going forward. Little hard to believe, right? So while we were sure that they can grow 20%, but it was very important to understand why they did not grow and what are the steps that they're taking. So when we had an interaction with them, what we learned from them is that they were behind the curve on a couple of product category innovations that happened in the global markets. And they fell behind that and they accepted that. And it was very encouraging that they were humble enough to accept that yes, we did wrong. And then they have corrected steps by bringing in a new CEO for Africa. They have a new CEO in India, and then in the first quarter they've done well. The second quarter is also good, despite one of the categories not doing well. So we know that the corrective action that the company has taken is being implemented, and it is there in the results, right? So maybe in the quarterly, not in the financials, final years. So with this kind of understanding, we are confident that this is a stock that we should go ahead with the buy recommendation, and that is how we approach these markets. So that is my answer to you. I hope
Thank
I've
you so
answered
much,
your
sir.
question.
Yeah, definitely, sir. Got it.
Yeah,
Thank you so much,
Good
sir.
afternoon, sir.
yeah.
Good afternoon, sir. Yogesh here.
Yes, Yogesh.
So I had a question.
Can you be a little loud, please?
Yes, sir. So during pandemic time, there was a scenario where all the share markets were going down
Yeah,
constantly at a higher rate.
yeah.
So what would be your suggestions at this point of time? How should we hold the grounds?
So it's very simple, as I told you, that even in the pandemic, we fell in 20 days. I think around the 12th of March, the alarm bell started ringing. By 23rd or 24th of March, we had bottomed out. How many days was it? It would have
Yes,
been about 12, 14
it
days,
was
right?
12 to 15 days.
If you go back to 2009, okay, 2008, after the Reliance Energy IPO came, market fell 2,000 points in 9 days, right? So it was at 6,000 odd levels of Nifty. It fell to 4,100. And then over the entire year, it kept collapsing. Okay. Now, the difference between the two periods is what I'll tell you. That was the first time. This is the second time, right? So, first time everyone was unaware of how to react, but slowly, the economic stimulus kept creeping in, and it was beneficial. Here, we knew exactly what to do, right? So, while there you had a 2,000 point fall, and then the market kept falling for a year. In this case, what happened? The amount of stimulus that was pumped into the system was unbelievable, but it was what was required, right? So when that kind of stimulus has come at that kind of level, do we expect more downfalls from there? No, right? And if you take the valuations of both that time, this time we were at a much lower valuation than we were when we were in the pandemic, in the financial crisis. So you are getting the stock market virtually at very depressed valuations, extremely depressed ever in the history. Okay, plus you had got a 3x stimulus that is being thrown out at you. So what happened? Market, see, money is energy, and money, if the real economy is closed, it will go into the it will go into the financial economy, because money has to go somewhere, right? It cannot stay idle. There's a cost of money. So if a bank has got money, if it cannot lend to real businesses, what will it do? That money will find its way into stock markets. So it went into commodity, it went into gold, it went into silver, it went into bonds, it went into equities, it went into ETFs, it went everywhere, right?
Yes, sir. Yes.
So this is how you have to apply the macro to the this thing, and for that you need to go back in history and study and come back. So that is why I am a very strong believer that you must study history of at least 10 years, if not 20, if you can.
So what resources do you recommend for searching and finding these histories?
All you need is a financial tables and Google. That's it. Nothing else.
Okay.
Everything that is ever written and printed is available on the internet. You have to take the effort to search. And you need to network. So if you're not getting something, pick up the phone, call up your alumni and say, I'm a student. Can you help me with this data? If someone says no, go to the next until you exhaust all options.
Yeah. Mention in equity analysis and P&L statement. Do we use a technical analysis to wave analysis also?
So, there was one very famous investor who made $55 million in the 1950. When he died, he was worth $55 million in 1950. Okay. His name was W.D. Gilgan. And he made all his money using astrology and technical analysis. And he said that use all the tools all the times. So whatever works for you, use it. So you can buy you can analyze a company to buy, okay, and you find it good enough to buy. You can time it with technicals. So what we call techno fundamentals is as a common parlance that is used. So I will tell you two things, that all tools work. I am in favor of all tools, but I think the most fundamental tool, which is equity research and valuation, should not be ignored at all. That you should know who the promoter is, you should know what the industry is, you should know how their strong financials are, what is the book value, what is the PE, you should know all these things. Okay, timing, whether you buying it for trading, for holding it for the long term, you are a value investor, you're a momentum player, all that will decide what are the tools that you will use. Whether you'll go with algo, whether you'll go with quant, or whether you'll go with technicals.
Yeah. So one more.
Good afternoon, sir.
Yeah.
It is always said that
Suniti, carry on.
sudden demand is always
Hello.
of pandemic in situation. The sudden fall is always fall. Rise in demand. So, so what people are speculating is in next. There going to be a sudden rise. So, what would be your comment on this?
There would be a
sudden rise.
We've already seen a huge rise. So now it depends. So see, the stock markets all over the world are connected at the hip. Okay. And you have to see everything in terms of money flow. That is very important. Okay. Second is, what is happening is that if you believe in the delta effect of stimulus, if you see the amount of money that is being printed, that much GDP is not being created. Are you getting my point? So you are inflating debt, but the GDP is not inflating in correlation. So the delta of the GDP to the debt inflation is coming down with every new this thing, and we have reached a plasticity stage where incremental stimulus might actually cause depression, right? And then you might enter a situation of stagflation, and then the inflation takes over. So you don't have growth, okay, but you have inflation creeping in. And today all that is not being seen, primarily due to the fact that your the interest rates have been artificially been kept low. So we have gone to into a NIRP, right? Negative interest rate protocol. So why is that happening? That is happening because everyone is buying bonds. So when you buy bonds, you raise the prices so the interest rates come down. So while they manage the interest rates, okay, imagine a time when suddenly you lose control over that negative interest rate policy. So as long as the going is good, things will remain, but there is always a potential uh, a bomb that can break because of this thing. And this is an experiment which is being done on a global scale, and nobody knows what is the outcome, what will happen going ahead. Because see what happens is every time there's so we are already automating our way in life, right? As humanity progresses, we are building an automation. What does automation do? It frees up human time. When it frees up human time, you get unemployed, right? So when you get unemployed, the only way to keep you busy is how to keep you with drinks, drugs, and video games. If I take all that away from you, you are going to go out on the street and riot with your problems, right? So to keep you quiet, they're coming out with this function called universal basic income, right? Now already the balance sheets of countries are beyond the point, okay? And while you can keep kicking the can down the road, okay, uh, there has to come a point when recognition will come and hit you, right? And that is going to be devastating. But as long as that moment is not come and more of the same is working for you, you be with it, but you must know that eventually this party is going to come to an end. I don't know when it will come to an end, okay? Because we would have thought 2015, 2016, and now we are in 2021, right? So how long this will happen? Inflation will come in. We will play inflation because now, despite pumping in the money, they're not getting the growth, right? So now they want to show growth, and the only way that they can show growth is through inflation. So for them, first it was 2% inflation, now it is 2% average inflation. You see how the body language is changing, how the terminologies are changing. So you have to be sure of 2-3 things, is that if this thing ends badly, you're going to get runaway inflation. And how do you protect yourself? Is to have a certain amount of money invested in gold. I would have told you crypto also, but in India, crypto is illegal. So you must have 5 to 10% of your savings going into gold, irrespective of the price. Because you know what? Ultimately, you have to have a store of value, right? And the value has to be recognized. And the only way that you can balance the books of any nation is by rapidly raising the prices of precious metals, which is the the store of value of the last resort. In this case, it is gold. And for that to happen, if your currency depreciates, and it can only be protected by raising the prices of gold. So gold has to be a very, very intrinsic investment, especially in this decade. You will be surprised by the rate at which gold can go. In fact, it might be profitable to remove the gold in your tooth. So some years down the line, when you're walking, make sure you don't have golden implants.
Yeah. Thank you so much, sir. Yeah, thank you so much.
Yeah.
Hello, sir.
Yes.
Sir, this is Nupur from second year. Sir,
Yes.
I had my internship in the same domain. So
Okay.
I wanted to ask, as an intern, it took me almost a month for the valuation of a single stock, including all the analysis, forecast, and
Yeah.
valuation, and also the key performance indicators that are used to forecast
Yeah.
for the valuation of a particular stock that keep on changing. So
Yeah.
in a company, there has to be someone who keep an eye on the indicators and to make the forecast. So it takes a lot of time, and the stocks keep on changing continuously.
Yeah.
So how does these two things are managed?
So today it is taking you 1 month. Next month it will take you 15 days. After possibly 4 months it will take you 1 week. And today I do one model a day. Okay.
Okay.
So experience and practice. So if you improve your speed on Excel, if you become proficient in Excel, then you can forecast at the speed of your thoughts. So if I tell you 8% growth, 5% next year, 3 over that, it's very simple for you. You put 853 and you learn your macros of Excel. So Excel proficiency is very, very important if you want to take an edge on the skill and grow very fast.
Okay. And so for example, one model is completed today as a professional, and
Yeah.
tomorrow also I need to keep an eye on the key performance indicators, and I'm working on another model. So,
Yeah.
is it possible to manage the two things simultaneously?
Yeah, so
Because
I think that see what happens now is whenever you are see there are two types of analysts. One is a sectoral analyst and one is a generalist. So a sectoral analyst would specialize in one sector and you would be having a portfolio of stocks 8 to 10, 12 stocks maybe, which you will be doing for a fairly long period of time. So not you don't have to, and all your models are automated. So if you make one change, everything changes, right? If you make a change in revenue, automatically the book value will change, the intrinsic will change. Suppose the interest rates change, then your DCF model will change because everything is linked, and that is the hallmark of a good analyst, right? So you must learn to not only have good Excel skills, but also build a model in a way which can be managed very easily. So it's about systems and processes, right? And
yes, sir.
knowing what are the key determinants that I need to change. So today, what happens? My analyst is working, like between 10th and 15th of November. My one analyst is having 12 or 13 companies coming out with results. Okay, so
Oh,
for him now, for me it might be overwhelming because I'm now more hands off, but that analyst of mine is more hands on, right? So he can manage it very easily. Of course it's a laborious task. Okay, it's challenging because he not only has to evaluate the con call, make his notes, modify the model, write his report, and also talk to clients. So while this takes up a lot of time, but if you were to give him only one job of doing the modeling, I'm sure he would manage it very peacefully in 5 days.
yes, sir.
So don't get alarmed by that. How do I do it? This, that, and the other. You just have to keep doing. So you build momentum, you build confidence, and that keeps driving you forward. So today I know 200 companies by the back of my arm.
Okay.
And why do I know these 200 companies? Because over a period of time, I know what are the things that I need to track. So I need to know. So I give you an example. If I'm looking at IndusInd Bank, I have to only see growth come back. Okay, because other things are being taken care of. If I'm looking at IDFC Bank, I know that I have to focus on the NPAs because they're at a very nascent stage. Okay, if I'm looking at ACC, all I need is volume growth. Okay, so when you know that what is the critical driving factor in a particular business, because you've already done those businesses, you already built those models, it becomes very easy for you to track them.
Okay. Okay. Thank you, sir.
Yeah.
Good evening, sir. Am I
Yes.
audible? Sir, we know that means any fundamental change in Wall Street directly impact our market also.
Yeah.
And considering the results of election,
Yeah.
this year it is not possible that we would have Trump bump like for 700 days rise.
Yeah.
So I have an interest in portfolio portfolio management. So
Yeah.
at this point of time, what are the uh, areas that I should be concerning? Because considering that there is a high liquidity, there will be more to learn. So,
Yeah.
so what strategy or something on that sort, what can be taken care of at this point of
So Saloni, I don't think that there is anything different that you need to do. Okay. Uh, it's all about the basic building blocks and fundamentals. You have to be very strong about your fundamentals. You must know your Sharpe ratio. You must know asset allocation. Okay. So when you talk of, see, it is, see, there are two things as a portfolio manager. Is the main function is not about stock picking, okay, which is the job of an equity research analyst. But for a portfolio manager or a fund manager, it is about asset allocation. Let us say I had identified Mastec and only bought 100 shares. And I put 20,000 rupees, it would be worth 8 lakhs today. How would it impact my financial situation beyond providing me incremental growth, right? It wouldn't. If I bought 1,000 shares, it would become 80 lakhs and it would be material, right? So the important thing is asset allocation. So when you have a story which you like and you are very convinced about it, you must allocate actively. So you must go 8-10% allocation. So there is one portfolio manager called Purnartha. He does only 2 stocks sometimes, or max 4 stocks. So that is the concentration that he has. And whereas concentration carries risk, it brings disproportionate gains. And what does he do? He has got 2 analysts tracking that company 24/7. So if he has invested 40% in Maruti, what he will do is he will go out into the street, he will travel the country, talk to vendors, talk to suppliers, talk to dealers, distributors, talk to bankers to get an idea of how the flows are happening. So he's doing a lot of secondary research to keep himself sure that he's got the pulse of the market with him. So for you, what is different from equity research and valuation is the fact that you understand valuations well, you understand that this is a good pick, and then when you are convinced that a stock is a good pick, you must ensure that you have asset allocated heavily. Okay.
Thank you, sir.
Yeah.
So we have some questions in the chat box.
Yeah.
So the first question is from Shikhar. He's asking, currently there's a massive rally in the share market. So do you see any possible correction near in future?
So see, a correction will always come, right? Market, if it has gone up for 7 months in such a pattern, it will obviously come. But how deep will the correction be? We have to take stock of a few facts. One is that GST collections have hit 1 lakh crore, okay, which is a very big number. Bank NPAs, which we were thinking were going to be very disastrous, they are not. On top of that, they have done a lot of capital raising, so they're on a very, very firm wicket. Okay, and now they will be putting that money to work, because you've raised money. What do you do with it? You will deploy it, right? So their costs are also down. They don't need incremental funds, so the cost will remain down. Liquidity is high. Interest rates in the system are going to remain low, and you have got a Democrat government in the US and you have got a Democrat Senate. So it's like BJP having Lok Sabha and Rajya Sabha majority. Kuch bhi law pass kar sakte hai. So in the US also it's going to be the same. There is virtually no friction for them, right? Last year there was a lot of friction. So there's no friction there. And what is going to happen is that economic stimulus package which will come is going to come out very fast. And there will be one initial spurt is going to be there. Okay. How long it will last? Again, then you should start falling back on valuations. Because ultimately valuation will tell you what is overbought, what is overheated. And when something is overbought, when the valuations are rich, you have to exit it. You cannot ignore fundamentals at any point in time because you never know when the hit will come. So correction aega, what you have to do, you have to rotate your portfolio. You have to, as the valuation of the market moves up, you must become less risk. Your asset allocation between debt equity should change. See, markets are very dynamic and your strategies also have to be dynamic. In March, you would have gone 90% equity. Today, if you suddenly feel that the market is at 20-25 multiple, you should be 50% equity going into debt. Or you must be liquid hedged. There are various permutations and combinations that you worked out. There is no one science that works. Whether a rally will come, who knows? Did you know that a pandemic would come? You didn't know. Do you know whether a correction will come in the future? Yes, it will come. It always happens. When it will come, I don't know. How much it will fall, I don't know. Okay, it's all a function of macro, micro, and the growth models that are there, right? So you must always move from high risk to low risk. Okay, asset allocation should change, and you should continuously be in a state watching to see whether things are going to change or not.
Yes, sir. We have another question as well. The next question is, for the case of unlisted companies, once we get the data to analyze, how to make sure that the very foundation, the data provided by the company, is authentic and credible?
So in today's times now, after the Modi government has ramped up on compliance, okay, the penalties are too heavy for the interested parties. You take independent directors, or you take the case of chartered accountants. Okay, they straight away get imprisoned. So no one is going to risk their name, no one is going to disturb their own financial models, and nobody is going to play this game of rigging accounts. Yes, there will be rogue cases that will happen. Okay, but one more thing, what I want to tell you is that GST is also a very, very big disciplinary factor, right? And with all the laws, and with all the algorithms that the income tax department runs, it's very difficult to avoid detection. Okay, so big cases get discovered now within no time. So one guy gets caught, then the entire chain gets caught. So people have realized that it makes sense to be compliant. Okay, tax rate is also very, very comfortable. 25% is nothing here. So we do not. While there will be cases which will be, there will be mavericks and there will be one exceptions to every rule, but largely 99.99%, I can say today that most of the negatives which were there about price rigging, cooking up of books and all that, is a story of the past. See, you know what? It's a jail without bail. So it's a very, very it's too much of a risk to take.
So we have one last question in the chat box, and that is from Harshita. It says, after preparing a financial model based on both qualitative and quantitative considerations, also taking account the industry growth, peer performance, and the pandemic, could you give us few tips to make our model more accurate? Any suggestions to work on it further?
So Harshita, what I will tell you is that don't try to make your model accurate. Now you will say that I'm offering you a completely contradictory solution. So the thing is that you can never know, you can never be accurate. Okay, accuracy, you're forecasting, and whether your focus is accurate or not, you will know it only in the future when the event has happened, right? So focus on getting the direction right. Number one, okay, ask your questions diligently, okay, and try to get your assumptions as close to the expectation, okay, and be conservative. It is better to err on the side of caution than to be 100% accurate on a model. So let us say that you say the company will report 10 rupees EPS and the company actually comes out with 12 rupees. See, you are not wrong. Okay, you got the direction right. You were conservative. What if that 12 was 9? Right? So it is better to be conservative and keep the upside open. So there is an up. So I write this phrase very often in our reports, saying that there is an upside risk to our estimates. So when there is an upside risk to your estimates, it's in your favor, right? You're leaving the ज़्यादा आ रहा है सोने पे सुहागा. It's like that, right? So focus on getting the direction right. Focus on getting your assumptions as logical as possible. Okay, and don't try to get a hit rate. I know there is a craze among analysts to get it to the point. They will say, "Oh, our forecast was only 1% away from the actual." Boss, that is a lottery. It's a total lottery, right? How can you decide what an organization is going to do? You are sitting here, you have an Excel sheet, they told you something, you put something on paper, you built a model. Okay, do you have control over his model? Even that guy does not have control over his model. Do you think he can do 10% growth, 11% growth? Usko thodi malum hai. Market is so dynamic. So rather than focus on the facet of accuracy, focus on getting the direction right and getting as close. So so when I say being conservative, you should not say 5 rupees growth. 12 रुपए कर रहा है 5 बोल रहे हो, ऐसा भी नहीं. Be reasonable and in the direction and try to get the direction right.
All right. Thank you, sir. Thank you so much.
Fine, ma'am. I told you I had a hard stop I need to leave. I have to go for a meeting
Yes,
and
sir.
travel.
Yes, sir. So with this, we come to an end of this interesting session. We would like to thank our guests for sparing their valuable time for us and enriching our knowledge and learnings. We would also like to thank the batch for their enthusiastic participation. Thank you all and have a good day. Thank you, sir.
Thank you so much,
I
sir.
really enjoyed this session and hope you have also learned and benefited from it. Thank you very much.
Sure, sir. Thank you so
Yes,
much,
sir. Thank you so much, sir.